So thanks for joining us, everyone. Happy 2021. As Greg mentioned, I'm Jos Herman. I'm an accountant. You're going to have to listen to an accountant here for the next hour. And I also have other designations in terms of my CFP and my tax and estate planning. So I love talking about tax. I've got a lovely little important consideration side of it. And if you think about what we're going to talk about today, we've got an opportunity to think about what's 2021 going to look like in terms of those opportunities for our clients. So it's just waiting for the slide to advance, and I think that's what Don was waiting for here. At my firm, as Greg mentioned, so I work with advisors directly and clients. I work with accountants as well, and I was mentioning to Greg and Don that the accountants may not understand what's going on in the tax and estate planning world. They may not have the time to deal with that, and so that's what I do. And so if you look at my outline here, we're going to talk a little bit about the personal side. There's actually quite a bit going on, especially when we hit January of 2021 and some of the things going on. We're going to talk about the new trust rules that are coming, and they will come quicker than you think, given the timing. We'll jump into the corporate side of things, and we'll look at, what do tax rates look like, et cetera. And again, we're going to bring this all home in terms of estate planning. From all of this, the biggest message I want you to gain is that we need to start asking some good questions of our clients. Where do they live? Where do they intend to live? Where are their assets? All those things like that. And that makes for good estate planning. So if we think about this in terms of the personal side, what's going on? What has happened? If I think about the personal side of planning, there is sort of I'll bring you up to speed on, well, what are your clients doing and what are maybe you've been doing during 2020 in terms of COVID. We found that household spending has been less, right? We haven't been able to go to Italy and all these things like that, but what have we been able to do? We've been buying more real estate. That's what good Canadians do. And so when you think about this and the COVID restrictions, people staying at home, again, you think about we've got more savings built up. So during the quarter of 2020, it sort of got to 56 billion. It's not at its record high that we saw back in quarter 2 of 2020, where we were hitting sort of 90 billion. Where did the cash go? Well, again, I think it went more to real estate from that perspective, and that meant mortgages, right? So we saw that, the household debt, they always give that number out, and that sits at about, 170%, and that was at Q3 of 2020. So when I think about, what Canadians are doing now, yes, they're, spending less, et cetera, buying more real estate. I think of this upcoming client meeting that I was telling, Greg and Don about in terms of every client meeting I have seems to be about them buying real estate, and them getting a mortgage. They're looking at a $2 million mortgage, et cetera. So given what I just said to you, given what I said about people saving more and they've got maybe more opportunities to buy insurance, to live where they want to, or to buy a recreational property, my head then turns to insurance. Again, do they need debt coverage in terms of that new mortgage that they're getting? Think about the future tax liabilities when we have additional properties on our balance sheet, again. And also the idea of equalization, right? Is this additional property or whatnot going to go to all 3 kids, or does it make sense to equalize in different ways? So again, I always think somewhere there's an insurance opportunity. So given the stats that I just showed you, absolutely. When I think about now CRA and where they've been sitting in COVID and et cetera, their audit activity did slow down, right? They had a lot more on their plate with new programs, et cetera, but they're always auditing. Now, when we think about what they're auditing, they're trying to go for high dollar things first. and they're trying to close audits that may have been stopped or halted because of COVID. But they did give some indication back in the fall there saying that they're going to look at more complex and more aggressive tax planning that's out there, especially things with trusts and partnerships, etc., and the so-called high-income earners. And of course, they like to look at real estate. So again, the markets of Vancouver and Toronto will be looked at in that realm in terms of, was this your principal residence, or are you just flipping houses, those things like that. So again, CRA did take a little bit of I'll say break, but again, they're certainly back and talking with folks again. When I think about, the tax world, and I think about, can tax rates change, etc., boy, every single year we talk about, can the capital gains inclusion rate change? It can, it has, etc. And again, it's talked about every year, like I said. If you think about I'll say the science or the research behind who's claiming the capital, who has capital gains income. Well, the Fraser Institute just put out a report actually this month that said actually those earning over $150,000 a year pay a much greater portion of the capital gains tax than most believe. So everyone believes the high net worth individual, they're the ones that should be penalized, etc. They're the ones that are paying the capital gains tax. But it appears to be not the case. So again, if you're looking for just a little bit of support in that of will they change the capital gains inclusion, well, have a look at that Fraser Institute report that they just released. Could they change other tax rates coming up? Just remember, we haven't seen a budget. We were supposed to get a budget back in 2020. We normally get them around March. So we'll see what happens with that respect. When I think about, this time of year, getting January, going almost into February now, it's tax time. And I think and I laugh, and it's always tax time. So again, clients have been thinking more about their estate planning, their will planning. Could they be more tax efficient? And so that's something I think that's encouraging that's probably happened out of COVID. So let's talk about some of the tax stuff that we're going to look for as we fill out our tax returns, etc., going forward. Everyone's staying at home, right? And so you've got a lot of people that were sent home to do work at home. And so now, can you claim your home office expenses? And so CRA, thought, well, you can do this, and you have been able to do this for many years. You just have to have a T2200, with you. But now they said, well, we realize how many T2200s would have to be filed or put together by the employer based on all their employees that are staying at home. So now they're saying, well, we'll let you have, home office deduction available, and we're going to give you a couple of options in claiming that. We're going to give you the temporary flat rate method, and we're going to give you the option of the detailed method. And this came out back in the fall under the fall economic statement that they released. And so I'm not going to go into the detailed method, but just so you know, if you do have employees or your clients have employees, they're able to claim $2 a day, again, if they worked from home in 2020, and to that max of $400. They don't need to complete that T2200 that I mentioned, and they don't need to complete the shorter version that's available, the T2200S. And there's no obligation or requirement to keep any records or provide records to CRA. If you think about, who's eligible to receive this or could claim it, I guess. It's for those employees that worked from home in 2020 due to COVID. You can have both the husband and the wife, again, in the home, both claiming it, so that's not an issue there. You must have worked more than 50% of the time for at least 4 consecutive weeks in 2020. So again, they're not judging, 50% for the entire year. And again, did the employer not reimburse them for those home expenses? And then finally, it wouldn't include any more motor vehicle expenses, etc. So again, more people at home, there's a potential opportunity to claim some of those home expenses. And again, if you think about the home expenses, you've got now the opportunity for internet access, utilities portion of your condo fees, and normally over time you were able to claim electricity, water, heat, all those good things like that. If you are looking for some more detail, CRA is here to help. They provided a list of 59 items that would be could be included in that listing. And they also actually provided a calculator to help individuals in their potential claiming of this expense. So something to think about. If you are self-employed, again, you have to go through the same concept of, again, did you bring people into the home for client meetings, all those things like that. So again, those more details are under the CRA's website. Now, if you think about this in terms of, 2021 and did tax rates go down or up, some provinces, their tax rates went down. Again, Alberta is one of those provinces. And whenever we have corporate tax rates go down, so again, the small business tax, like 11% in some provinces or 12 or even 9 in Manitoba, you have to have integration whereby now if I want to pay a dividend out, you're going to have to pay a higher dividend. So again, whenever you have lower tax rates corporately, you then have to then say, will dividend rates go up as well? So again, since Alberta dropped their rates, we'll also have just a slight increase in their eligible dividend rates, and that'll just go up slightly from 31% to basically 34%. And I'll give you a whole big slide that shows all the other provinces when we talk about personal tax rates going forward. How about OAS? So again, we all have thresholds in terms of what's the amount for 2021. Of course, this is now bumped up from 2020. So again, anything above this amount would have what's called that clawback, and I'm just using air quotes on that. So that now sits at $79,845. How about CPP? This is a bigger slide that has a whole host of information here, but I kind of wanted to give you a trend of what's been happening from a CPP standpoint. The contribution rate, if we look back since 2018, has sort of increased over time, right? It was 2018, we're sitting at 4.95, and now when we go into 2021, that's going to go jump up to 5.45. And that sort of trend is going to continue for the next few years based on the Liberal government's changes that they had back in, I guess, 2019. If your contribution, you're self-employed, that's now going to be to 10.9%. So think about this in terms of the max earnings. That has also slightly increased for pensionable earnings for CPP. That now jumps to $61,600. Our basic exemption, though, has stayed flat, right? That stayed at $3,500, and that's been since 2018. If you think then, now here's the employer that, again, has to put into CPP. We were sitting at about $2,500 back in 2018. If you were self-employed, that meant about $5,100. But now that's creeped up, hasn't it? And as we jump into 2021, that employer portion is going to be $3,166, and again, if you're self-employed, now you're well over $6,300. So again, I'm an advocate of paying salary, right? Because when I think of the insurance world, it helps the insurance company identify if you're trying to get disability insurance, all those things like that. If you're looking at the owner-manager paying salary, then maybe they can contribute to RSPs. There's options when we talk about paying salary, but I'll say the cost of the CPP portion has certainly gone up. And the accountants are looking at this more to say, does it make sense to pay salary or dividends? And right now, of course, we're paying more dividends than we would salary whenever we think of owner-manager compensation. So it's a good just discussion to have with your clients about how are you paying yourself? Is it salary? Is it dividends? Has that changed? And is it going to change as we move forward with things like, CPP? I think whenever you talk with an owner-manager about, splitting income, that has certainly changed, right, over the last few years. And in a large part, it comes down to TOSI. Remember TOSI, that tax on split income, whereby if I'm a business owner and I have my spouse and my children in my corporation and I want to pay them a dividend, well, they will be taxed at the highest marginal tax rate unless I go and, get them out of the exemptions that are available. So this whole idea of income splitting has been sort of changed over time. And again, TOSI has been part of that. What has been, always been floating around, let's be honest, are prescribed rate loans. That's a way of income splitting. And if you haven't participated or your clients haven't participated in, a prescribed rate loan, they're trying to figure out, well, if I've got TOSI to deal with and I've got, a higher rate income earner as opposed to one that's of lower income, how do I push income to them? So what prescribed rate loans do is you can have a loan between non-arm's length parties, can't you? So that means between spouses, between parents, trusts, etc. So essentially, I loan, maybe it's a portfolio or part of my portfolio into to that low income earner. And maybe it's a spousal relationship whereby, again, I make more money than my spouse. And again, they now take the income into their hands. And then we would have a rate under a prescribed rate loan rate where they pay back the interest, etc. So this has been happening. It's a way of income splitting. Why take all the income into your hands if I can now sort of income split with other individuals in my family, etc. So the prescribed rate of interest is set by the Government of Canada, and they publish it every quarter, as we know, and the CRA publishes it, right? And we did see a drop of that prescribed rate from 2% down to 1% back in July. And we go and we think about, well, can we now take opportunities to take advantage of the lower rate of 1%, right? So if you think about refinancing is one of those things where you go, well, if I make changes to the loan arrangement, then that'll put the prescribed rate loan offside. So we don't want that. So this question was put forward in the CRA roundtable back in the fall that said, well, if I have an individual that has a prescribed rate loan at 2%, and let's say it's $100,000, and let's call that loan 1, and they borrowed that money and they went to go buy some securities for that $100,000. And let's say now the securities or the investments went up to $200,000. And now the client says, well, hey, I heard that, the rates are now 1% and they want to refinance this loan at 1%. Can they do that? Is there, adverse tax consequences? Well, let's say that the client then, resells half of that portfolio. So remember, I've got a $200,000 portfolio now. I sell half of it for $100,000, and I repay that first initial loan of $100,000. The client would then get another loan for $100,000. So let's call that loan 2, and then they would use that new $100,000 to buy some more investments from you. Well, again, if you think about that, what did the CRA say? So like I said, it was under a CRA roundtable under question 11. And what the question was posed to CRA was, can you confirm that there's no attribution associated with the securities that were still owned and also those that were purchased with loan 1? So that's an important question. So attribution rules, remember, basically say, well, hey, if I'm loaning you something, especially in an arm's length transaction, is the income actually going to attribute back to me? So we don't want that as a taxpayer. And actually, the CRA then also confirmed that there's not going to be investment or any attribution on loan 2. Okay, so that's the other thing that we need them to confirm. What CRA did confirm was that there's not going to be attribution in those scenarios. So here's the biggest message in all of this. The CRA is saying as long as you structure things properly and you're going to refinance, there's not an issue when it comes to not having attribution apply. And when you think about this loan arrangement that could be happening with your clients, or maybe even the accountants are suggesting, make sure that if they do have any loans outstanding in 2020, that the borrower, so let's say it's the spouse or the child or whatnot, that they repay the interest back no later than 30 days after the year end. So again, we're coming to that close quite quickly. Otherwise, all those income splitting benefits will be lost. So I think there's absolutely still opportunities for clients to consider those 1% rates. I want to layer on insurance, right? It's always going to turn back to our insurance conversation. So if you do have prescribed rate loans that are out there, maybe they can be insured. You know, again, remember you're loaning these amounts over to another individual. So again, I think that there's a way to insure a couple of people in those prescribed rate loan arrangements. So again, something to think about. So I've got home expenses that I could deal with. I've got, ways to split income. RSPs, again, those are my max contributions are going up. So again, if you do have, those slight opportunities of $500 to put more money in the RSPs, that could be an opportunity from that perspective. So again, $27,830 when we go into 2021. How about TFSAs? Boy, we certainly haven't gotten a lift on those contribution rates or amounts. So again, it's still sits at $6,000. So that hasn't changed from 2020. How about CRA? What did they have to say about who has TFSAs? I think this is kind of an interesting thing. They said there's about a little over 20 million TFSAs that are out there, and there's about 1.4 accounts per household or per holder. So remember, the client may have a TFSA with you, but they may also have a TFSA with the bank or another advisor, etc. The total contribution room, if you haven't contributed since 2009, since the inception of the TFSA, those clients could put in $75,500. So again, good opportunity to save. And again, when they talked about the unused average TFSA contribution room, meaning, are people maximizing their, contributions over the years since 2009? There's still a lot of room in TFSAs. So again, I encourage you to, keep having those conversations about having some tax-free dollars, saving inside those TFSAs. So some interesting stats. How about those clients that, again, have a U.S. connection? So again, if you're in that investment world, remember last year the IRS released a guidance that said that taxpayers were, they didn't have to file these 3520s, etc., if they had RESPs and RDSPs. But the guidance didn't apply to TFSAs, right? So under the U.S. regime, they, see TFSAs like a foreign trust, don't they? And so there has been some sort of court cases that came out of the U.S. recently that sort of gives an indication that that the TFSA is not a trust under U.S. tax law, and there's no requirement to file Form 3520, which is really just an additional reporting obligation for those that are U.S. citizens. So again, it's not a binding position of the IRS, but again, something to think about of making sure, are your clients have a U.S., connection? Are they a U.S. citizen? Keep asking and asking, where were your clients born, etc. That brings me to, this whole idea of beneficiary designations. The beauty of RSPs and, TFSAs, etc., is that we can have beneficiary designations. It's, this whole idea that I can give this particular asset to a particular individual or charity or whatnot. And again, we can do that with life insurance, right? So again, I can have choice in who my beneficiaries are. I can bypass the estate. So, for any of those that are in provinces that are of high, probate regimes, again, there's some, tax savings there. And when we think about life insurance, those proceeds are always received on a tax-free basis. So again, beneficiary designations, they do work and they are powerful whenever we talk about tax and estate planning. But I sometimes am the bearer of bad news in terms of some of the court cases that have sort of come out in terms of beneficiary designations, etc. The first one, I don't want to go too much into it, but it kind of stems from the fact of you need to know who your client is married to, is in a relationship with, or whatnot. There's some court cases that have floated around in 2020. There's the Turner one that happened in BC. There's a really high-profile one in Ontario, the Klinsman and Latner case, where they weren't married. They weren't in a common law relationship, but there was enough, I'll say, evidence to say, well, you guys presented yourself as a married couple. You guys presented yourself as, again, staying at each other's houses and things like that. So again, the result is that, these relationships have gone to court. That last one I mentioned in Ontario, the Latner case, it was a rich couple, and she ended up getting tens of thousands of dollars of spousal support, even though they weren't married. So again, I want you to just keep those things in the back of your mind. On the other side of the coin, we had Komulski. Remember Komulski? That one happened back in March of 2020. And I'm going to give you a little schematic here just to remind you what happened with Komulski and Komulski, especially when it comes to beneficiary designations. Remember, it was an Ontario case, and this was Dad who was well into his 90s, and he had twin sons, Gary and Randy. And, it turns out that when you look at the beneficiary designations that were finally made, the joint account got put in Gary's name, and also the RIF. So we had basically nothing going to the estate, i.e. to Gary and Randy. So Gary's going, well, my goodness, what's going on? So, of course, Randy took Gary to court. And you would think as any, investment professional, insurance professional, when you think about, beneficiary designations and joint accounts, they would go out of they would bypass the estate. We have this mentality or this understanding. Well, the judge found that the sole named beneficiary of a RIF was not the plan's ultimate beneficiary owner. The judge found that the beneficiary holding that RIF was actually in trust for the deceased estate. So it wasn't just going to Gary. The judge decided in this situation that Gary was actually holding those RIFs for the estate, i.e. that both Gary and Randy would both benefit. So it's an interesting one where, you have to turn your, attention to PCOR versus PCOR, where it brings in this idea of a resulting trust. And you're going to hear a lot about that, whereby, even though it's a named beneficiary, was the gift or was the asset actually intended to go to that one child? And this was a court case from many years ago where if you do have those situations, the adult child actually has to prove that it was for them. It was a gift from Dad, and not a gift and meant to be for the entire estate. So I think this is an interesting one because Komolsky and Komolsky basically kind of throw beneficiary designations out the door, don't they? As we sit here in January, we haven't seen any appeals or anything like that. Could there be? Don't know. But here's what happened, and I want you to be aware of, because this is sort of concerning from a estate planning standpoint. The Ontario Bar Association said, okay, well, we don't think this is right. So they delivered a submission to the Attorney General of Ontario and also to the SLRA in terms of the Insurance Act, and said, if you kind of let Komolsky stand, it's going to increase litigation, especially when you have beneficiaries that are different than what the estate is, right? Doesn't that make sense? That's exactly what happened in Komolsky. And think about those situations where, again, you made a beneficiary designation for an ex-spouse or child or whatnot under, again, a divorce settlement. Well, that could be thrown out the door, right? If things like, Komolsky kind of stand. So I think this is a positive move by the OBA. And what they're saying is, especially on the Insurance Act, because again, our focus is also on insurance, is they're proposing to the amendment to the Insurance Act, where it says when a designation is made by contract or declaration under that particular subsection, there's no presumption of a resulting trust. This, in terms of the estate, it should go to the beneficiary. And what they're hoping to do then with this, proposed amendment is to say, okay, maybe that'll take away some of the, litigation that could be resulting. And again, it would be up to the estate to prove that it was actually a resulting trust. So I think out of Komolsky, it caused some concern, especially in the estate community. The OBA has taken action to see if some amendments can be made, so it's sort of a wait and see. What I do want to say and reiterate is document the intent, right? I don't think the lawyer made that situation happen. I don't know what happened on the advisor side. Again, if Dad is saying, I really want this money to go to Gary, document that. And again, this will hopefully mitigate some of the challenges by beneficiary, under beneficiary designations under this. So stay tuned. I think something will come out of 2021 with respect to this more. How about trust reporting, right? This sort of popped up back in 2018 under that budget. And it said, well, hey, we know that there's trusts out there, absolutely. But if I really have no assets in the trust or, or if I distribute out to beneficiaries, et cetera, I really have no trust reporting that sort of CRA wants. And if you think about trusts and why people create trusts, well, who's a party to the trust? I need to have a settlor. They're the ones that come in and settle the trust, and this is an age-long requirement. And then I have a trustee. So remember, the trustee is, again, sort of the king or queen of the castle, let's call it, that must abide by the trust deed and for the benefit of the beneficiaries that are involved. So there's structure, there's, all these individuals or parties that are involved when we talk about a trust. And we see a lot of trust when we talk about estate freezes, don't we? So when the client says, oh no, my accountant's taking care of me, we're doing an estate freeze, this is usually what it looks like. So again, parent freezes their shares, they then issue new shares to a family trust, and I can make different beneficiaries like sons or corporations, etc., and I can defer the tax over to the next generation. So instead of giving the shares directly to the son, he's going to be the beneficial holder of his shares through the family trust. So again, no reporting that was required. So when you think about trusts and what they do, essentially they act as protectors. They act as a way for Dad to control there's a way of providing privacy, isn't there? That's really what trusts fundamentally do. Forget about the changes to the income splitting rules and all those things like that. So given that, and my last point in there about privacy, like I said, currently trusts don't have, that don't earn income or make distributions aren't required to file like this trust tax return, this T3. And those that do file aren't required to report who the beneficiaries are, right? So it goes back to privacy and all those things like that. Well, as we have taxation years for trusts that are ending December 30, and you'll have to see that I put 30 in there intentionally, 2021, they now have to report. So again, if you have, your clients have trusts and all those things like that, and they continue to be in place past December 31, 2020, the trust will need to comply with the new reporting rules. So they need to disclose, who was that settlor? Who are the trustees? Can you tell me about the beneficiaries? And again, any protectors that are involved. That's a lot of disclosure. There's a lot of disclosure because they want to know, not only know the name of that beneficiary, but they want to know where they live, when were they born, where do you live, and any sort of identification number from a tax perspective. So again, I think there is this idea of privacy is sort of going to be lost. And so tax practitioners are sort of saying, do you really need this trust? Do we need to make some changes? Do we need to wind it up or restructure? So that's something I think that they're working on. And the challenge in all of this is that we do have some, I won't say challenges, I'll say challenges, but also some positive things. There's exceptions to this rule, this reporting rule. So again, if you've got segregated funds and master trusts and you've got RSPs and TFSAs like we talked about, there's no requirement from this new reporting rule. If you go to the lawyer and they have those trust accounts, that's not caught under these new rules. The last one there, in terms of a trust that holds less than $50,000 in assets, okay, so that could be, again, those small trusts that are out of this new reporting regime. So we've got lots of exemptions. But the question is, what about insurance trusts? KLU made representations to finance asking that an exempt life insurance policy issued by a Canadian resident life insurance company should be part of that listing, should be part of the small trust. And whenever you're applying that, $50,000 asset limit, the CRA, has said no at this point. The Department of Finance has said no at this point in time because, again, as you know, the cash surrender value versus the fair market value of a policy can be quite different. So, is there other submissions to be had? Possibly, but again, remember. KLU is trying to keep their eye on the ball on this, and they did pose it at the last KLU roundtable with respect to that. So remember, like the use of insurance trusts are quite beneficial, right? Like you could have the insurance proceeds be received by the trustee of that particular insurance trust for the beneficiaries, and then it can be distributed out accordingly to the trust agreement. So they're very effective. As a control tool, a privacy tool, all those things like that. And again, I can make an insurance trust and I can settle those death benefit proceeds under a trust agreement, or I can do that within my will. So, I've done presentations before and even to IDC about beneficiary designations and how do you do insurance trusts. So again, that might be another topic as we go into 2021 again. If I sit there and I say, well, what about tax in general for Canadians, etc.? Right now, remember, we don't have a Canadian estate tax or an inheritance tax or a gift or wealth tax. But again, there has been rumblings about, should we get a wealth tax in Canada? And again, that's consistent with the Liberals and their wealth inequality, and the NDP had proposed that. So, the whole idea of a wealth tax, it does happen in other countries. Again, what should the assets include? You have countries like, Spain, et cetera, or India that have these. And so it's interesting when we think about this idea of should we have a wealth tax in Canada? I don't think it's happening, but, as we saw with 2020, anything can happen. So if we don't have a wealth tax and we don't have an estate tax, well, certainly the U.S. do, don't they? So I remember how I said before, we need to ask our clients, where were you born, right? If you were born in Maryland, you are automatically a U.S. citizen unless you renounce, right? That doesn't go away. So when you think about, the whole U.S. election and what's happened, if you are deemed as a U.S. citizen, you've got income tax on a worldwide basis if you're a U.S. citizen or a green card holder, right? And so you've got formal annual requirements from that perspective, even if you still live in Canada, right? So when we think about income tax, and if you're a U.S. citizen, let's just say, and you're, et cetera, you're taxed on worldwide tax. They've got anti-deferral provisions, like if you have corporations that are in other countries. You've got FATCA. So remember FATCA, the insurance companies are asking under this obligation. And again, you've got various compliance requirements. But we also have transfer tax in the United States. So remember, they have, if you die and if your assets are of a certain amount, and if they're above the exemption that currently exists, and it currently is $11.7 million, then you would potentially pay U.S. estate tax. And again, if you're a married couple that is both the U.S., it comes at over $23 million. Even Canadians that have U.S. situs property can also fall under a potential U.S. estate tax. So again, always ask where the assets are, and again, are you a U.S. citizen? Now the question is, will this exemption, this federal exemption that sits in the U.S., will it change from an estate tax standpoint? Well, it's going to sunset, right, because they kind of go in different tranches, and it's going to reset, let's call it that, as we start 2025. And so technically it'll go back to $5 million, not the $11 million that I just showed you. So there is concern, right, where again, since we have the Democrats controlling, the legislative and executive branches, could the exemption drop from $5 million to, let's say, 3.5 back in the Obama days? Possibly. Could the exempt tax rate also change? So right now the highest tax is 40%. Could it go as high as 55%? So again, don't know. Could there be changes from the personal standpoint, the corporate standpoint? I put in there to be determined. There's a lot on the Biden administration in terms of the issue of, will tax changes happen? Well, remember, Trump bought in lower tax rates. He brought them down to 21%. A Biden administration has been talking about going to 28%. The other thing that, has sort of popped up in the United States is this whole idea of a step-up regime. So again, if I inherited a house or something from my grandmother many, many years ago, there's no additional tax to be paid once I inherit it and then the growth on it, much like we do in Canada. There has been talk about, do they want to change that regime in the United States? So as a U.S. person living in Canada, my biggest thing is, just make sure that, you know your tax reporting obligations. Consider estate tax as part of that. If you have that property down in Florida or whatever it is, that's part of that property. That's included in the calculation for the estate tax. But here's where we sit with U.S. citizens and green card holders, all these situations like that. People are going, I don't want to be a U.S. citizen anymore, right? And so the number of people that are saying, They want to expatriate. So saying, I want to give up my U.S. citizenship has certainly increased. And then we've certainly seen that in the last 3 quarters of 2020. So again, we'll see how the tax changes happen in the United States. We'll see how the Biden administration gets through probably COVID first, and if these numbers rise. What we did see, very interestingly though, is that we saw a shift of the wealthy in the United States. So remember, I've got a bunch of tax havens around the world. There's Switzerland, there's Jersey, which is, again, in Europe. Now, some of these, structures are now sitting in North Dakotas and Nevadas and Wyomings. If I want to set up a non-CCPC in Canada, some of these, Delawares are popping up. We also saw California residents saying, nah, I don't want to be, see any palm trees anymore. And they're moving to the Montanas, the Texases, the Floridas, and Nevadas. And you may say, why in the world, where I live with palm trees and I've got beaches, would I ever move to another state? Ladies and gentlemen, it has to do with tax. There's some potential new taxes that are potentially being proposed, and they're being proposed under Assembly Bill 2088, where it says we're going to impose a wealth tax. So if you're a California resident and you have more than $30 million of assets, we will apply this wealth tax. And it's not only going to apply once you move away from California, it's a trailing tax, which will follow you for the next 10 years. So that's why you saw Elon Musk move to Austin. You saw some corporations move to the Floridas. I think Sylvester Stallone just moved the other day to Florida. It's all about tax. You can always visit California, can't you? So I found that very interesting in terms of movement. So on the corporate side, let's shift that way. We saw, as I mentioned, on the U.S. side, could there be changes? Don't know. From a Canadian standpoint, we saw some changes from a corporate standpoint. Corporations, as you know, the reason why I probably set up a corporation is for various reasons: creditor protection, tax deferral. Remember, tax deferral happens when I retain income at a tax rate that's less than that owner-manager's tax rate, right? I don't need all the money, so I keep it inside my corporation. And if you think about, if I keep too much, passive investments inside my corporation, you have 2 things happening. We have the passive investment rules, absolutely. And then if you want to claim the capital gains exemption, you need to make sure that the corporation's pure or you have the right structure in order to claim the capital gains exemption. So remember, as we sat in 2020, our capital gains exemption was about $883,000. It's now going to jump up to $892,000. So I would claim the capital gains exemption if I'm selling my shares or at time of death, and I could potentially claim it on an individual basis. For those in the farming world, that's still sitting at $1 million, and I haven't seen any movement from that perspective. In Ontario, we had a change in terms of those that can incorporate. So remember, if I incorporate as a dentist, a doctor, an accountant or lawyer, even a real estate agent, I can do that under a personal real estate corporation. And I can do that in different provinces, right? I go to BC, I can do that, etc. Ontario has made the same change whereby a real estate agent or broker can now be incorporated as a professional. And again, they have rules under their bylaws to say the voting shares would go to the real estate agent, and then the non-voting person would go to, again, family members, etc. So again, insurance opportunity. Right? Insurance opportunity. We can insure those real estate agents. How about IPPs? IPPs, I think, I worked with a client last month to finalize their IPP. Again, they had been paying salary over a number of years. It made sense for them to look at that. We did have changes in Ontario again, whereby now, when you think about the contributions, they aren't restricted to the provincial side of it. So again, especially in COVID, you don't have to always make those contributions as required under the provincial rulings. So again, something to think about when we think about IPPs, investments, etc. They're not provincially legislated in Ontario, now effective going into 2021. And you will now join other provinces like Alberta and Manitoba and BC that don't enforce the provincial enforcement on that. So again, good news. Here's what we think about the corporate planning side, and we'll sort of, let you know about, things are happening, estate freezes are happening, the discussion of CDA is always happening. Remember our lovely calculation when it comes to CDA. Remember that the death benefit less the ACB is the credit to the capital dividend account. So again, it's right in the Income Tax Act. We're not making it up. When I have a credit to the capital dividend account, I then can pay tax-free dollars out of the corporation. Remember that there was a KBU conference where we also had that CRA roundtable where we asked that question previously about, again, the small trusts. They also had a question about what if you had a life insurance contract and there was a return of premium because there was an excluded activity. So again, the shareholder had passed away because of suicide or scuba diving or something, or skydiving. The question posed to CRA was, are you going to treat those return of premiums as proceeds of life insurance? So essentially they're asking, are you going to treat it as tax-free dollars coming into the corporation for the calculation of CDA? Really important question. So the CRA did confirm that, yeah, they'll want to make sure they look at the policy to make sure, but they also did confirm that it's not going to be a disposition. There's no adverse tax consequences as long as the contract says it's a return of premium death. And in doing so, that means that those proceeds will be received tax-free, and it will be a credit to the capital dividend account, and then we can able to pay tax-free capital dividends from the corporation. So again, really positive news from that standpoint. In closing, the importance of CDA is key. I just used the word tax-free, right? I can pay out tax-free dollars out of the corporation. So corporately, think about this. If I have passive investment income, it attracts really high tax rates. So it's about 50%. If I want to take money out of the corporation, let's say it's as dividend income, it can be high as 49%. And if we think about, the capital gains tax that our shareholders face by owning these shares at death, there's another layer of tax. So you're basically facing tax upon tax upon tax. I want CDA. I need CDA to push dollars out the door tax-free. So, if you see my corporate tax rates that are across the country, and I didn't put every province, and I really apologize, but we tried to hit the common ones. Alberta, you've always had low tax rates. Again, general tax rate over $500,000 sits at 23%. And investment income is lower compared to everyone else at 46.67%. Everyone else is over 50%. So that was my first line item. And as I mentioned before, if I want money out of the corporation, I can pay myself a salary or dividend. But again, these are close to around 40–50%. So again, I want CDA to pay dollars tax-free out of the corporation. These are the concerning numbers that business owners should be aware of. And when we think about this idea of paying a capital dividend, a tax-free one, I want you to give your clients choice. I want you to give the accountant choice to say, we either can pay out taxable dividends on the death, of the shareholder or someone, or we can pay tax-free capital dividends. It's either 49%, like in BC, or we can pay tax-free ones that are at zero rate. Give choice, right? And so if you think about estate planning, CDA is certainly part of that from a corporate standpoint. When you think about what estate planning is, it's all about control. It's all about the control to distribute the property the way you see it, right? But you have to know what you own first, right? That's the key thing. Do you own property in the United States? Do you own property in another province? All those things like that. So I just put up here, and I don't have any association with Manulife, but they have a great creditor checklist for executors. Connect, if you want to, what the number is for it, I'll certainly pass that along. And finally, is there liquidity to fund the tax liability at death? If these clients are saving more and they're buying more real estate, is there liquidity to fund this tax liability? And do we have a tax-efficient liquidity mechanism, like life insurance, to help in the estate planning? So I think there's lots to absorb here. No matter if, what's going to happen on the personal front, if we have, more room to save, etc. If clients want to restructure and they've got, trusts, etc., that might look different. And again, corporate side, we talked a little bit from the U.S. side, but certainly on the Canadian standpoint, if you're trying to save more in your corporation, the concern then is, are you paying too much tax? And do you need CDA? That whole idea of estate planning should involve CDA. So this is me. As Greg mentioned at the top of our hour, my firm is an independent firm, Resources and Solutions. I gave you my contact information there. If you do have any further follow-up questions, which I'm sure there will be, or if you want to partner with me in the future, I'm certainly available. But I want to thank you for your time, and I want to hand it over now to Greg. So thank you.
Thanks, Jos. Don, I know we have some questions. Don, did you want to take over the questions?
Yeah, we've just got another one in here. So what other than, one question was, what other than suicide would be excluded death events which would allow a return of premiums to go into the CDA account?
Yeah. The example under they put forward was like skydiving.
Oh, okay.
That makes sense, right?
Yeah. Well, as long as it's not suicide.
yeah. For some people, skydiving is suicide. You're right.
I wouldn't go there, but anyway. Can we access the checklist for executors from Don Irvine?
Don, I can pass it along, or we can make arrangements to get that out to people. I think it's a really
important. That might have been actually from Lamar. So I think if you had some checklists, we can send that out or put it up on our Win Big website as a follow-up with your contact information, Jos. Another earlier question was, you talked about home expenses being deductible through COVID. Is that for, say, husband and wife are working two different businesses, two different locations, obviously, but from one location at home, can they both deduct home expenses for their business expense deductions?
Yeah, it seems to be no exclusion for having that husband and wife scenario. Yeah.
Okay. And what about sorry, go ahead.
Yeah, it's a temporary measure. So if it makes sense for you in 2020, then claim it. Yeah.
And what about a Canadian citizen who owns property in the U.S. that is under the value of $200,000?
Under $200,000?
Mm-hmm. I guess it's a small condo or something, maybe.
Oh, I see. Yeah. Okay. So when we talk about, am I exposed as a U.S. or as a Canadian citizen that owns the Florida condo, right? There's a calculation involved. So remember that $11 million number? There's an exemption there where it says, okay, I have to do a calculation. So what did you own in the U.S. as this property, and then what did you own worldwide? So they prorate that exemption. And so you have to kind of do a little calculation with your accountant to see if you're exposed, or maybe some planning is just try and get rid of it. Either way, there's going to be maybe some tax to be paid depending on your other assets, etc.
Got an email from someone that says that they may have sent you some questions directly. Do you want to just look in the chat room and see if anything was sent to you directly, Jos? I know there was one question that particular individual asked, was the deadline for filing for tax returns this year, is it still April 30th or has there been an extension?
Yeah, good question. Boy, last year we certainly had some delays and whatnot. I know CPA Canada has suggested to our lovely friends in CRA to say, should we consider it for going into this year? And I haven't seen any changes yet. Shoot for April 30th.
Yeah, when it came up actually through the webinar, I looked on the website, and the Revenue Canada website didn't make any changes yet. It still says April 30th. So, and obviously those questions, you can actually go to the website at CRA, obviously. And if anything does change, we'll let you know as well as advisors of IDC.
Yeah.
Did you notice any questions directly in the chat there?
Let's see. I think that the individual actually probably emailed them to my email.
Okay.
Let's take a quick.
So that's the two questions about that. So obviously many people are asking about the slides. I know we've recorded the webinar and we'll provide the webinar up on WinBig in a few hours. Again, can you, if you send me the slides, can I forward those slides to individuals who are requesting them or participants of the webinar? Are you okay with that?
Oh, absolutely. Our purpose today was to provide you a whole host of information. And so, yeah, we absolutely have the slides available, and we want to make sure that you're informed as you go into 2021.
Perfect. Can we take the 25% reduction in the RIF minimums?
Yeah, so yeah, the new proposed, that they changed back early in 2020. Yeah, so if you haven't done so, then then make sure that happened. But I haven't seen any changes going into 2021 regarding them keeping that.
A question I know, Jazz, this will be close to Jazz's heart, is that someone's asking. You didn't mention the split the split dollar CI in terms of the return of premium. Have you heard anything new, any rulings recently on the split dollar CI and ROP?
Yeah, no, good question. Yeah, I haven't seen anything. I think there's sort of other things on the plate or whatnot. So I know that I'm putting a presentation together just on that topic. So because there's lots to absorb just even on that front.
Another question is transferring of ownership of a CI contract from one corporation to a related corporation. What impact would I face with that?
Yeah, we talk a lot about the insurance side of, is there a taxable disposition and whatnot. But remember, that policy potentially could have some value there, right? So depending if they're sister companies or, a stack corporation, there's ways of sort of moving it. But you can't guarantee that there won't be any tax in doing so.
Another thing that's in and out of favor every once in a while is you mentioned IPPs, RCAs. Where do we stand these days with RCAs? Are they still something to consider?
Yeah, Don. I mean, think about that. I mean, you don't hear too much about that. I haven't seen much movement on that or changes or more people getting into it. Are they still out there? Absolutely, but kind of silent on that front.
Yeah, and I just want to remind everybody that if you do get a situation like an IPP or an RCA, we do have Brad Hyde, Chris Britton, and of course Frank Abate in Ontario to contact directly. So we have those resources, and of course feel free to reach out to Jos as well. Greg, over to you. I think that's all that we have for questions right now. Let me just check to make sure. Can you explain the difference between the U.S. estate tax between $11 million and the $3.5 million proposal?
Yeah, so whenever they say this is the exemption, they kind of put it in 10-year tranches, and they say this is the amount that if your estate is less than that, you won't be exposed to U.S. estate tax. So it's an additional tax, which could be, basically at 40%. And so, yeah, and so this 10-year window, or I guess less than that because Trump changed it, is going to expire as we come into 2025. So, again, a few years from now. And if it expires in terms of what it sits at right now, it'll drop to $5 million, which it was before.
Right.
What the Biden administration said, no, $5 million as an exemption isn't good enough. We want to make sure the wealthy are paying their fair share of tax. We're proposing $3.5 million as the exemption. So anything above that, you would be exposed to the U.S. estate tax. So that's where sort of the moving numbers are. Will it change? Don't know, but something will happen either way, like it or not.
And in the States, if I'm not mistaken, the house would be included in that estate tax because it's
Yes.
not exempt as a principal residence, right?
Yeah.
That's right. Yeah, and life insurance.
Okay, and life insurance, right. So if I'm withdrawing $100,000 a year from my corporation, is there much of a difference in the net personal income, whether I do it as salary or dividends, since the salary, there are withholding taxes?
Yeah, and that's where, the accountants always come in and say, oh, it's more expensive, to pay the salary, right? Because you saw the CPP costs and all those things like that. I will say it just depends on what province you're in. I always go back to the accountant's more inclined to pay a dividend, but they are coming around to say maybe we should pay some salary, some dividend. Okay, because I think that works nicely, because now you can participate in maybe some of the government programs that are available. As we saw with COVID, they asked, did you have earned income of more than $5,000 or T4, all those things like that. So I like a blend, to be honest. I think accountants are sort of trying to move that way as well.
Okay, and one final question. Can the proceeds from a corporate life policy be paid through the CDA on to a trust on death?
Yeah, so as long as, again, you want to make sure that trust agreement does have some language in there. So again, if it's a family trust or whatnot, you need to make sure that there's an opportunity to do so. If you're looking at an insurance trust, that's another way to look at it. So again, there is ways to have trusts involved in the planning.
Yeah, you've mentioned that a couple of times, actually. And that is a webinar that I'm looking at scheduling as an insurance trust webinar as well. So I appreciate that comment. Greg, you want to wrap it up, and then we're
sure. Thanks, Don. All right, Jos, thank you very much. Always informative. I know we had an extremely good turnout, and people stayed on right to the end, coast to coast. So thank you again. I think one of the things that really jumps out in the last hour was your comment about you can always visit California. And, I think everyone on this call, as well as a lot of people coast to coast, especially in Western Canada, can't wait to take a trip down to sunny California. So thank you for sharing that. Coming up next week, we have from the offices of IDC Worldsource, our compliance officer, Eric Wachitel, on Thursday, February 4th. And check the IDC WIN bulletin for that. And again, on behalf of everyone at IDC Worldsource and all the advisors, Jos, thank you again. Awesome, really good presentation. Thank you very much.
Thank you, everyone, for joining us. Have a great day.
Have a great day, everyone. Thank you.